latest news from financialmirror.tv. The European Central Bank left its main interest rate at 4.25% on Thursday, though President Jean-Claude Trichet said policymakers did consider a cut as the Eurozone economy slows and inflation risks lessen. Trichet said economic activity in the euro area is weakening with contracting domestic demand and tighter financing conditions, adding that annual inflation rates are likely to remain well above levels consistent with price stability for some time. He said the Governing Council had examined two options at its monthly policy meeting: to keep rates unchanged or decrease them, concluding that the Council was right in keeping interest rates as they are. All 81 analysts polled by Reuters last week had expected the ECB to keep rates at a 7-year high of 4.25% for the third month in a row, due to its concerns about above-target inflation of 3.6% in September, which is still above the ECB's ceiling of 2%. However, economists believe that rate cuts are inevitable. The only question is when. French President Nicolas Sarkozy will host the leaders of Britain, Italy, Germany and the European Central Bank on Saturday to discuss their response to the financial crisis, as France and Germany clash over the idea of a US-style financial rescue fund for Europe. Meanwhile, futures markets suggest the Bank of England will cut interest rates to 4.75% next week and to 4% by this time next year. A Reuters poll showed 45 of 66 economists said the Bank of England would hold rates at 5% next week. And some good news from Switzerland's UBS, which has written off more than any other European bank this year because of exposure to US toxic assets, announcing it would make a small profit in the third quarter. The US Senate endorsed a revised $700 billion bailout plan to prevent an economic catastrophe, leaving the House of Representatives to decide its fate in a second vote on Friday, after rejecting an earlier version. President Bush, speaking after Wednesday night's 74-25 Senate vote, called the bailout essential to the financial security of every American. Market participants have warned that the US bailout plan, equivalent to some $2,300 per American, is not a cure-all, with a worsening economic outlook sparing calls for central banks to cut interest rates. Senate leaders hope that sweetening the plan with a tax cut and extended federal protection for bank deposits can turn no voters in the House into supporters. Many Americans resent the idea that Wall Street is being bailed out at taxpayer expense and have put pressure on members of the House, all of whom are seeking re-election in November. House prices fell 1.7% in Britain last month to post their biggest annual drop since 1991, according to Nationwide. Interest rate futures rallied as investors speculated the figures increased the chance of an interest rate cut by the Bank of England next week, although analysts cautioned that a cut in itself would do little to halt sliding property values. Mortgage approvals are already less than a third of what they were a year ago, and figures from the Bank of England Thursday showed lenders expect to restrict credit even further in the coming months. Nationwide said house prices in September were 12% lower than a year earlier, while the construction sector was also down. The 11th consecutive monthly decline highlights the sharp reversal of fortune for the property market since the credit crunch took hold last summer, bringing an end to a decade in which property values almost trebled. September's decline pushed the average price of a property to £161,797, the lowest since February 2006. Marks & Spencer is reining in investment, slashing costs and stepping up promotions amid signs of worsening consumer sentiment in the UK. The clothing, food and homewares group posted a 6% drop in second quarter core sales on the day that it opened its first shop in mainland China. But shares in the group, which have plunged over two-thirds to a 7.5-year low on Monday, jumped nearly 9% amid hopes the steps being taken will mean profit forecasts will not have to fall much further. With the worst Christmas for at least 30 years coming up for non-food retailers, Britain's shoppers are struggling with higher food and fuel costs, plunging house prices and growing economic uncertainty. Analysts expected profit forecasts of £690 million for this financial year and £575 million for next year to remain unchanged, but down from £1 billion at the start of this year. If you think you're the sexiest financial analyst on Wall Street, then the term bear market will have a new meaning for you. Playboy magazine is offering a new way to lose your t-shirt on Wall Street and is searching for models to pose for its February feature, Women of Wall Street. Nearly 20 years since the last one was published on the same theme. In the past, Playboy has garnered attention for big business news themes with Women of Enron and Women of WorldCom, after the spectacular failures of those companies. The magazine is seeking current and former employees of the financial world and is especially interested in those with more senior job experience. Models must work for a financial institution or have recently worked for one and prove that they are at least 18 years old. Playboy wants 20 women and will offer each one between $500 and $2,000. So if you want the attention, the opportunity, the experience, and if it's not really for the money, then apply to www.playboy.com/wallstreet. Thank you for watching financialmirror.tv.